This is level 2 of the CFA program, the topic on derivatives and the reading on pricing and valuation of forward commitments. Notice that the words pricing and valuation are used in the title, and oftentimes those two words can be used interchangeably. Not so the case here in this reading and perhaps for lots of derivative topics. So I will show you the distinction between pricing and valuation, and you'll see how that distinction is super important as we go through these learning outcome statements. I'm pretty sure that this is the first reading where every action word is describe. So we're going to describe, and notice there are all different sorts of forward and futures contracts. And so those are the two main types of forward commitments. And then we'll end with some swap contracts, which are really just kind of a series of forward commitments. But I also want you to pay close attention to the italicized words over at the end of each of those LOSs. So we're going to do lots of calculations here. So make sure you have your financial calculator ready. Let's go ahead and start with a brief recap. Forward commitment. We probably know this back from level 1. It's a contract, so that's important, a legal and binding contract. So you are obligated to do something. You're obligated to either buy or sell an underlying security at a predetermined price sometime in the future. Now, this is super different than an option. Remember, the option gives us the right, but not the obligation. So I'm going to refer back to these forward commitments as legal and binding contracts when we get to those options readings. A handful of different types of forward commitments. I already mentioned these, right? Forward contracts, futures contracts, and swap contracts. So let's go ahead and start with the most basic and probably the easiest of the three: forward contract. Contract between two parties to buy or sell the underlying asset. Long position agrees to buy the asset. Short position agrees to sell the asset. And of course, this is super important as part of this whole concept of derivative securities, is that when you and I sign this forward contract, there is no capital exchanged. That's one of the reasons that makes them so popular. Let's see, down the left-hand side of the embedded bullet points, let's look at some terminology. So here's that first distinction I was talking about just a few moments ago. The price of a forward or a futures contract is that pre-specified price that the buyer should pay the seller. Now, of course, if you and I enter a forward contract over the next 3 months, what's going to happen during that next 3 months is that the price of that underlying asset is going to fluctuate, right? Some days it'll go up and some days it'll go down. And so during that interim time period, before the maturity date of the contract, one of us, or perhaps even both of us, might want to know what the value of our position is. And that's where the word value comes from. And so notice that purple bullet point. It's the current monetary value determined after contract inception. So think of it this way. The price of the contract is incurred today, right? We figure that out today. But then after we establish our position today, then we move through time and the value of that contract will change. And of course, the value of that contract changing is important to each of us because one of us may want to get out of that contract. So if we want to get out of it, we need to know how much we are going to be required to pay or how much we can expect to receive. So pricing and valuation, those are just action words to describe how we're going to come up with the forward or futures price or rate, and then of course the value. And then we'll go ahead and talk about this carry arbitrage model. And this is going to be super easy for you. And it's also going to be extremely important in terms of figuring out where we can find undervalued and overvalued derivative contracts. Now, look at that last arbitrage definition down there. This is the simplest of all kinds of definitions, that these emerge when identical assets are mispriced. In other words, you have the price of one asset in a market and the price of an asset in a different market, and they ought to be the same, or at least their present or future values ought to be the same. When those things diverge, then we have arbitrage opportunities. And so let's go ahead and take care of that part of the LOS that asks us for assumptions of arbitrage. And that first purple one is just kind of a restatement of our last bullet point. Replicating instruments. Oh, this is really important. So the replicating portfolio, the replicating security, the terminology in this reading is replicating instruments. Well, first of all, you can identify them and that you can invest in them. You know, it's one thing to say, oh, here's a security that pays me $2 over the next 4 days, let's say, but I'm aware of a contract on Mars that pays $2 over the next 4 days. Well, you probably can't invest in that Mars forward contract, so it has to be investable. And then, like lots of cases in financial theory, we kind of assume that transaction costs are gone, markets are frictionless. Short selling is allowed. Of course, that's super important in derivative markets. And then borrowing and lending is available at the risk-free rate of interest. And there are a number of reasons why we use the risk-free rate in derivative securities, and not least of which is that in forward markets, at least historically, and of course it goes on in today's environment, that individuals and organizations that entered a forward contract were trying to find a perfect hedge for either the ownership of the underlying asset or the sometime in the future ownership of that underlying asset. And so they were hedging. If a perfect hedge is enabled, then you're locking into a future value, and that must mean that there's no risk. So let's go ahead and use the risk-free rate of interest. Now, there are tons of other reasons, and we'll talk about those at length when we get to the options readings. All right, moving on to equity forwards and futures. And so this could be called, this LOS could be called, describe the exact same thing that we just did, comma, let's go ahead and include equity securities as the underlying value, and what else is there to consider? So this is a good slide to illustrate. There are carry benefits and there are carry costs. So the benefits of owning the underlying equity or the bond is that you receive the dividend or the interest. We'll do bonds here in just a few slides. The carry costs are what I was talking about with my car, right? My car in the driveway, maybe I can't drive it, you know, whatever could happen out there. So think about how these opportunity costs relate to equity securities. So that interest rate, that's a carrying cost. And then storage. Now, of course, in the old days, you had to store an actual certificate of a stock certificate. Nowadays, you don't. I don't know that anybody stores those. I'm sure there are some people that do, but not too many. Now, this is super important. Carry costs are added to the forward pricing equation. Carry benefits are subtracted in the forward pricing equation for the simple fact that if you invest in the derivative, you don't get the benefits. You don't receive the dividend. The owner of the share of stock, the owner of the bond, receives either the dividend or the coupon payments. And so this is kind of the opposite of what you think. So let's go ahead and do this quick example, calculating the price of an equity forward contract with discrete dividends. All right, discrete just means they're going to happen every month or every 3 months or every year. All right, current stock price, $50. Dividend of $1 in 30 days and in 90 days. All right, the price of a 70-day forward contract. All right, so that's important. Notice that 70 days falls in between 30 and 90. Okay, so the contract matures in between those two dividends. All right, so we have a 4% interest rate. And so what we're going to do is we're going to look at that first line. We're going to compute that forward price just like we did before. However, we need to subtract out the dividends, and not only do we need to subtract out the dividends, we need to subtract out the present value of the dividends. So look inside of those brackets. We have the spot price, right, S sub 0, minus the present value of the dividends received at that time period. So there's our present value factor. So that's 30 days, right? That $1 in 30 days. So, right, we need to discount it back 30 days. So 30 is in the numerator. And then we're just going to subtract that present value of the dividends from 50. And we get the 49.37. Notice at the bottom, we have a couple of arrow points on bonds. We'll do those in just a second. Now, here's a good pricing and valuation of equity forwards slide. Notice we're doing the exact same thing that we did before, but we're just subtracting out those dividends. And of course, in the first row, those are discrete dividends. And in the second row, those are continuous dividends. So make certain that you read the question stem and be aware if the CFA Institute says, hey, discrete, then use the top. Hey, continuous, then you use the bottom. And of course, for continuous, you have to use the little e to the x button on your calculator. Let's take a quick example here. Pricing equity futures contract, continuously compounded. All right. What do we have? Dividend yield of 4%, index spot is 17.5, continuously compounded annual interest rate 0.20%. So the 6-month futures price is closest to. So we're going to take that futures price. It equals to the compounded value of the spot price. But instead of doing 1 plus, right, we're now going to do the e to the x. We're going to raise that to the difference between. Remember, we have to take out that dividend yield. So notice we're taking out 0.2 minus 0.04. And what is this? A 6 months. So we got to do 6 divided by 12. So there's 17,170. So the futures price is less than the spot price, which is very common. It's not super common, but it's common in financial futures markets because you don't have to pay to store the car out in the garage. So there are few storage costs. And so, hey, I mean, look what's happening here. In this case, if dividend yields exceed that continuously compounded annual interest rate, then that futures price is going to be less than the spot price. So don't have a heart attack on the exam if you see this example. How about if we do this with discrete dividends? And so all we're going to do is subtract out that 50 minus the 99. So that gets us the 49.37, which is what we got back here somewhere, didn't we? Yeah, we already did that. So now let's go ahead and look at equity forward valuation. So notice what we're going to do. We're just going to take the difference between the spot price and the present value of the forward price. And we're going to have to do that according to being quite sensitive to the time periods. Let me show you what I mean in this example. So there we are, priced at 120. There are, 1-year forward contract was purchased at 110. Now the spot price of that underlying asset is 120. There are now 6 months. So we're halfway there to the maturity date. 4% compounded is the interest rate. Value of the forward contract is closest to. So we're going to take that current spot price, right? The current price of the underlying, which is 120, minus the present value. Remember, we agreed to trade at 110 at the end of 6 months. At the end of 1 year. Now we have 6 months to go. So we're going to take the present value of that 110 at the 4%, but now we have just 6 months to expiration. So once again, 1.04 raised to the 6/12. And that's the value of the long position, right? We purchased at 120, price went up, so long position has to have benefited. Now, one of the things that I think is interesting about the difference between forward contracts and futures contracts is that forward contracts, which may or may not be traded in the over-the-counter market, lots of forward contracts are uniquely tailored to individual client needs. But sometimes there's lots of volume out there in the secondary market. And so forward contracts, they can be priced every day, and lots of them are. But for a unique contract, they don't have to be priced until one side of the contract has a need for that valuation, right? Futures contracts, on the other hand, these things are traded on organized exchanges or vast over-the-counter markets, and so they are characterized by marking to market, and this happens every day. So look at that middle embedded bullet point over there on the bottom right. It means that the market value is received or paid at each daily settlement, and so the contract reverts to a value of 0 every day. So with forward contracts, it's important to know that the value of your contract changes over time. Could go up or could go down, and you may or may not choose to get out of that contract. So you have to know what that value is on that date. Now, of course, you might want to know the value of that contract for other reasons. Maybe you want to use that contract as collateral, right? Rehypothecation. I'm not suggesting that you want to do that, but there are other reasons that you need to know the value of that forward contract. You don't have those choices in the futures market. The exchanges and the rules require you to settle every day mark to market. So let's go ahead and start with this carry arbitrage model. And to do that, I want you to just think about a simple example. Let's suppose that I have a used car. Out in my garage is a 5-year-old Honda CR-V, and its Kelley Blue Book value is $20,000. So there's the spot price. So I could sell that to my neighbors or anybody else in the secondary market for $20,000. But you come to me and you say something like, you know what, Jim, I really, really like that car of yours. I would like to buy it, but I'm going out of the country for 6 months. And when I come back, I want you to sell me that car. And so you think about my decision as a financial decision maker. I could say to you, if I were a super kind person, I could say, you know what? When you get back in 6 months, just pay me the $20,000. But then I start thinking and scratching my head, and I say to myself, wait a minute, I could sell and get that $20,000 today in the spot market, but if I have to wait 6 months, I'm going to have to store it, right? I'm going to have to pay insurance. I'm going to have to come up with a model so that my sons don't come in the middle of the night and take my car out for a joyride or park it somewhere and it gets impounded. So there are all these kinds of risks. So this carry arbitrage model is based on some kind of an assumption that the spot market and the forward market are different markets. And in their basic senses, the difference between those two comes down to what's known as the cost of storage. So I may charge you not $20,000 to buy my car in 6 months, but maybe $21,000 or $22,000 because I have to do all that stuff. I have to incur all of those costs. Now the question then becomes, let's suppose that $22,000 that I just said to you was a fair price. If it's a fair price, then there are no arbitrage opportunities. But if there is an arbitrage opportunity, maybe my neighbors have exactly the same kind of car that I have with the same miles and the same scratches and the same dents. And they just entered forward contracts to sell their cars for $25,000. Wow, then you're getting a really good deal, right? What could you do? You could enter this contract with me and then you could buy the car for $22,000 and then maybe sell it for $25,000. So let's go ahead and look at some of these assumptions. Arbitrage, we know this. It requires no investment and there is no price risk. And what that means is that in both the spot and the forward markets, there are these arbitrageurs who are trying to take advantage of you and me in the used car market, either by taking the long position in my car or taking the short position in my car. So let's go ahead and take a look at some specific mathematics, and then we'll work through a couple of examples. Now, what has the CFA Institute and all of your finance professors taught you since the beginning of time? They've taught you something that sounds like this. The price of any security, the price of any financial security, is the present value of what you expect to get out of that. For shares of stock, it could be a dividend, could be free cash flows, could be residual income. For bonds, it could be coupon rates, and those coupon payments could be fixed, they could be floating. Discounted securities like treasury bills and bankers' acceptance, you get a maturity value at the end of the time period. Well, I want you to just flip that upside down. If we're trying to come up with a forward price, we're not interested in present value, we're interested in future value. So look at this formula here. This is the most super simple formula that you can come up with. So the forward price is equal to the spot price compounded out into the future. 1 plus the risk-free rate of interest raised to the t power. And so if that theoretical price there, if that equals the actual forward price in the market, then there is no arbitrage opportunity. But let me give you a quick example. You guys know, if you've been watching my videos since level 1, I love talking about my financial calculator. Let's suppose that this financial calculator is right here, and you guys need this financial calculator. But for some reason, you don't need it for 6 months because you're not going to start studying for another 6 months time period. So you ask me, you say, hey, Jim, how much would you sell me this calculator for today? And I say $100. And you say, well, I don't need it today. And plus, I don't have $100 today. Let's agree to trade in 6 months when I need it. And so let's suppose all that stuff that we talked about with my car is appropriate. And we agree to trade at 110. So you and I sign a forward contract, and we agree to trade this for 110 in 6 months. Fair enough? Well, what do we know? We know that one of us in 6 months is not going to be happy. Let me go ahead and make a crazy assumption. Now, we know the price of these 12C calculators are relatively stable, but play along with me here. Suppose that these things are crazy volatile instruments. Price goes way up, price goes way down. Well, we know by signing this forward contract that one of us is not going to be happy in 6 months. Let me give you just a quick example. You and I agreed to trade at 110. So 6 months from now, let's suppose the price, the spot price of this calculator is $150. Man, oh man, you're going to be so happy. You're going to hand over 110 to me. I'm going to hand you the calculator, and then you have a choice. You can use it to study, or you could go sell it for 150. Either way, you benefit. I'm super sad, right? So when you sign a forward commitment, most likely you're going to experience the feelings of pride or the feelings of regret. You're very proud of yourself. You're saying, man, I was so smart to sign that contract with Jim. Me, I'm feeling like an idiot. I'm saying, what did I do that for? I could have waited and sold this calculator for $150. All right, so you see how the price fluctuates up and down, and that's going to dictate whether or not we have things like valuation of the forward commitment over time, and then what happens to arbitrage opportunities. So here's just kind of a condensed version of what I was talking about there. So the forward is overpriced. All right, so that's the example if I said something like, what did I say, $150, right, versus the 110. Well, that forward is overpriced. And so this is what I want you to do. I want you to skip down. If the forward is overpriced, skip down to the big box at the bottom left. Notice what we're going to do. We're going to short the forward contract. So this is what you're going to do in answering this question on the exam. If the forward is overpriced, if 150 is greater than 110, short the forward contract. And that's called the cash and carry arbitrage model. But on the other hand, suppose that in 6 months, the price of this financial calculator is only $40 or $50. Then we do this reverse cash and carry arbitrage and skip down to the bottom right. We're going to take the long position in that forward contract. And so what we're going to do is we're either going to borrow some capital today for cash and carry, or we're going to short the asset in the reverse cash and carry. So if you do those two things there, if you remember those, then I think you ought to be okay in answering that question. But let's go ahead and work through a quick example. Let's suppose we have an asset priced at 130, spot price 130, risk-free rate 4, and the forward price is 140. So let's go ahead and throw our simple old compounded time value of money formula at this model. So we have the 130 times 1.04. We're just assuming for simplicity's sake 1 year. So there's 135.20. So clearly 140 is greater than 135.20. So what we're going to do is follow these steps, right? So the forward 140 is greater than the 135. What did I tell you? We're going to short the forward contract. Here, let me just go back here to remind you. There we go. Forward is greater. So we're going to short that forward at 140. What we're going to do is borrow the 130 at the risk-free rate and then purchase the underlying asset with that loan. And then here's what we're going to do to determine that initial cash flow. So this is important about the description of the carry arbitrage model and then what the outcomes are going to be. So notice what we're doing. We're subtracting 130 and we're adding 130. So those cancel out. But here's where we get that arbitrage opportunity. So what we need to do is we need to take the difference between the 140 and the 135.20. There you go. Look at almost the very bottom, second to last line. And then, of course, we need to take the present value of that. So notice what we're doing. We're looking at future prices, but then in order to figure out our arbitrage opportunity, what did I say just a few moments ago? We need to take present values, right? Present value and price always mean the same thing. So what do you get there? $4.62. So there's our initial cash flow, $4.62. Notice that there's a plus sign in front of that. So you have that capital today. So then what we need to do is skip ahead to the maturity date of the contracts. And so what do? We deliver the underlying for plus 140. We repay the loan minus 140. So that's a wash. And what do we get to do? Well, we can go back here. We just get to keep that $4.62. And so you'll see this as we go through the next example. For the arbitrage to work, here, let me go back here. You're going to have a positive cash flow today, and then you're going to have a zero cash flow at some time in the future. This sounds like, hey, you didn't use any of your money, right? You didn't take any risk, so that you have no cash outflows at some time in the future. Cash and carry arbitrage. Now, let's go ahead and work through this one just as quickly, but let's turn everything upside down. So there's our asset, spot price 130, risk-free still 4, but now the forward price is 115. So we can redo the math, although we've already done it, so we know that 135.20. And so we're just going to, just stand on our heads, right? Do the exact opposite. That's why it's called the reverse carry arbitrage. So we're going to take the long position in the forward contract, and we're going to short the underlying asset. So there's the 130 and the 130 again, and then we're going to lend those funds for the underlying purchase, right? So there we go. So we're going to take the 130, there's the plus, and the minus the 130, so they wipe each other out. The question then becomes, what is our cash flow? What is our cash flow today? Well, we take the difference between the 135 and the 130, and of course we need to take the present value, so we get around $5. So there, cash flow at time 0 is a plus 5. What do we get to do with that plus 5? We get to keep it. And so if this slide makes any sense, when I hit the next slide, what's going to happen at cash flow at time t? Just skip down to the bottom, right? There you go. There's $0. Of course, there's $0. And so you can work your way through those steps, which are the reverse steps of the carry arbitrage. Now, one word of caution as you're answering this question on the exam. If you do the carry arbitrage and let me go back here, and you get a negative number for the initial cash flow, then the answer has to be the opposite one, right? You're not gonna lose $4.62. You're not gonna do reverse arbitrage here in this case when 140 is greater than 130. All right, so what have we done so far? We figured out how to deal with pricing, and we figured out where there are arbitrage opportunities. So now what we're going to do is say, let's go ahead and enter the contract. And then let's see what happens during the lifetime of that contract. And let's see what the value is. All right, so let's take a different example here, right? So we've got this 1 year forward, 130. 3 months later, right? So we don't know what the price of this underlying asset is going to do, right? Remember when I did my calculator, I said it was super volatile, could go way up or could go way down. We don't know what's going to happen there. So now 3 months later, the contract increases, the price increases to 132. So if we're long, right, that makes sense that the price goes up. We ought to win. So the question is, how much should we have won? And if we took the short position, well, how much should we have lost, right? So, right, this is a zero-sum game in the forward market. All right, so this is a super easy calculation. So all we're going to do is we're going to take the difference between the 132, which is a present value, right? That contract price increases after 3 months. So that's a present value, even though we calculate it as a future value, right? 132, that's the futures price today. And then all we're going to do is subtract the present value of our original futures price. And here's where you have to make sure that you pay attention to the details, right? So we're going to take that 1.04 and we're going to raise it to the 9/12, which is the remaining time on the contract. All right, let me go ahead and repeat that. So we have 1.04 raised to the remaining T. Think of that as the remaining time until the contract matures. So you get, what is that, about 72 cents. So the long position wins 72 cents. The short position loses 72 cents, of course, zero-sum game. And then make sure that you multiply that by the notional principal of the forward contract, if one is given to you. Sometimes in forward contract problems, there is no notional. In swap contracts and forward rate agreements, which we'll see in just a few moments here, those notionals always given. All right, how about if we move on to these other kinds of interest rate derivatives known as a forward rate agreement. All right, so these are forward contracts. So everything that we talked about over the last 30 minutes or so apply to a forward rate agreement, but the interest rate is now the underlying asset. So what we're going to do is we're going to say something like this. You're going to come to me and say, hey, Jim, I need to borrow some money from your bank. I have Jim's bank. But I don't want to borrow that money today. I want to borrow it at some time in the future. And let's go ahead and just throw time out of the equation. Let's make it easy. Suppose you come to me and say, Jim, I want to borrow all this money a year from now, and I want to borrow it for a year. So we scratch our heads and we say, all right, what kind of an interest rate can we come up with? What will the interest rate be a year from now on a 1-year loan? Well, what do we know? I mean, we can observe the 1-year rate. We can also observe the 2-year rate. From that 1-year rate and from that 2-year rate, we're going to come up with what kind of a rate that we can apply to this forward rate agreement. So let's go ahead and talk about some of these underlying assets. So the London Interbank Offered Rate, I'm guessing that most of you know that by the end of 2021, this LIBOR interest rate is not going to be the accepted underlying interest rate for a variety of reasons. That's a conversation for another day. And so we're moving to other kinds of underlying interest rates. Euribor is one, and then the securitized overnight financing rate is another one. And so I'm guessing on the near-term exams, the CFA Institute will probably still include LIBOR, although I don't know that for a fact. But it doesn't really matter what rate they give you. Whatever rate they give you, that's going to be the underlying asset. They could give you Jim's interbank offered rate, right? JIBOR. Who knows what that means? All right, let's go ahead and get some definitions out of the way. Counterparties, so the short position, this is the fixed receiver. And the long position, this is the floating receiver. All right, so think about what that means. If we are long in a forward rate agreement, that means we're going to receive the floating rate. So what do we want interest rates to do? We want interest rates to go up, right? Buy low and sell high, more or less. So look at those 2 bullet points inside of the embedded bullet points. Short position makes a profit when the market price exceeds the forward price. Long position makes a profit when the market price is below the forward price. The FRAs are identified using the X times Y convention. X is the point where the FRA expires. So there's the derivative, and then the underlying loan starts, and then Y is the point where the underlying loan ends. And I think this is a really good slide just so that you make certain you understand this X times Y or the X by Y notation. And so notice what the Institute does. It gives you the FRA and then it opens the parentheses. There's a 0, so that's time period today, right? Then H is going to be the time period of the derivative, and then M is going to be the time period when the actual loan ends. Now, if you skip down to the bottom, pricing of forward rate agreements, I want you to look at that equation there, and I want you to go ahead and close your eyes and say, okay, I can memorize that thing for the exam. And of course you're going to have to, but I'm going to give you a super easy way to memorize this, although you're going to have to pay attention to the time, just like we did in those recent examples. So this is what I want you to do. I want you to play along with me. I want you to get out your financial calculator, and I want you to do this with me. You ready? Let's suppose that I sold you an asset for $100 today, and a year from now, it was worth $110. What's your return? How would you do that? I need to take my glasses off because I can't see. So I'm going to do 110 in my calculator, right? And I'm going to divide by 100, right? And I'm going to subtract 1. I'm going to get 10%. Now you should be saying, wait a minute, Jim, that was a waste of 20 seconds of my life. I learned that back in 5th grade or maybe even kindergarten. But what did we do? We did the following. We bought at 110. We put that in the denominator. We sold at what did I say? We bought at 100. We put that in the denominator. We sold at 110. We put that in the numerator, and then we subtracted 1 to reflect the compounded interest rate over that time period, right? Buy low and sell high. Well, that's the same thing that we're doing here. So I want you to go back to the example I just gave you just a few moments ago. Suppose you come to me and say, hey, Jim, I want to borrow some money, but I want to do it in a year. And let's suppose that 1 year rate is 5%. And the 2 year rate is 10%. So you're tempted to say something like, okay, 1 year rate is 5, 2 year rate is 10. Well, a year from now, let's just agree on a 5% interest rate, right? 10 minus 5, that sounds about right. Well, that's not a bad estimate, but it doesn't reflect the whole bunch of time value of money stuff that you've learned from the very beginning of level 1. So this is what I want you to do in your calculator. Ready? Clear it. I want you to do the 1.1, right? 1 plus that 10%, and then 1.05 divide, and then subtract 1. What do you get? You get 4.8%. So we were kind of close when we estimated. And so this is what we're going to do here. We're going to have 1 plus, so L sub 0. So there's the LIBOR, right? And that's the longer term LIBOR. So we assume that we have an upward sloping yield curve. So that would be the higher number, and we're going to divide by 1 plus L sub 0, which is the shorter number, and that should be in an upward sloping yield curve, the lower number. So I want you to think about this. When you get to this example, this question on the exam, make sure the yield curve is upward sloping. Just put the bigger number on top, put the little number on the bottom. How does that sound? Let's go ahead and work through a couple of examples. Before we do that, let's do a timeline here. I tell my students all the time, and I told you back in level 1, that when you get to a time value of money problem, if the answer and the solution and the process is not obvious, draw a timeline. And I think that's good advice for this one here. Draw a timeline, put a 0, put an H, put an M, put an H plus M, and so you know what those numbers are, which then leads you to the correct answer as we'll go through this here. All right, you ready for this? So a 1/6 fixed FRA rate is closest to, all right, so notice that LOS, describe how and calculate and interpret the no arbitrage value. So the first thing that we need to do is come up with this 1/6 fixed FRA rate. So what we're going to do is we're going to take All right, notice what I said, 1.035, right, divided by 1.02. So those are given. Notice one is kind of blue, one is kind of red. So skim up and down. You'll see where those numbers go. There's the 180-day divided by 360 in the numerator. There's the 30-day divided by 360 in the denominator. We're going to subtract 1, just like we did the 1.10 divided by the 1.05 minus 1, right? We did all that. So we're adjusting it for less than annual compounding, and then we need to divide over there by the remaining term, right? So divide by the 150 over the 360. So 150, where did we get that? Of course, that's 180 minus 30. So there we go. There's the fixed 1/6 FRA rate for this particular derivative, 3.79%. Now I'm guessing that if I were to have just done this, suppose I just did this, suppose I said, okay, this is what I want you to do. I want you to memorize that formula, and then apply that formula. You're thinking, oh my gosh, where do I keep track of the H's and the M's? All right, so my simple example of the 1.10 divided by the 1.05, that should lead you to the correct answer. Combining that, couple that with the timeline that we drew here, and then you should be perfectly fine there. Now the question then becomes, of course, just like we did with the forwards and the futures, let's go ahead and value these things, right? Calculate the new FRA rate at time G. So all we're going to do, look at the payoff. We're going to take our FRA rate at time period G, sometime in the future, minus that first initial rate, and then we're going to adjust it for time, right? M over 360 times whatever that notional amount is. Remember I said to you earlier that with the FRA, you're almost always going to be given a notional amount. And then, of course, you have to take the present value. So let's go ahead and work through an example here. So here's our 6/9 FRA term. The fixed rate is 0.75%, notional $300,000. All right, what are we given? 90-day US LIBOR is 0.8. 180-day LIBOR is 0.85. At the time, the 3-month US LIBOR is 1%, and the 6-month is 1.1%. All right, so valuing the 6/9 3 months after initiation using 30 and 360 convention, all we're going to do is take the present value of the difference between what we had before, right? That 7.5 minus, well, we have to compute this. So we're just going to go ahead and do this again, right? We're going to calculate the new FRA rate. And so what did I have there? Oh yeah, I have the 80 and the 85. Those are in red and in blue. So notice in the numerator, there's the 85. In the denominator, there's the 80, and the 180 over the 90 and 360 times the 90. So there it is. There's the 89. So what was our fixed rate? 7.5. Now our new rate is 89.82. So to get the value, we're just going to take the difference between those two, right? 89.82 minus the 75. And then we have to adjust it for the M, right? So there's 90 days times that 300,000. That gives us 111. And then we need to discount that back at the 1%. So where did we get that 1%? So go back here, right? Assume the applicable discount rate for the FRA settlement cash flows is 1%. So discount that at 1% over the half year, right? You get the 110.60. Now, I did say a few moments ago that we were going to go ahead and have a slide or two on forward contracts on bonds. So here we go, right? So fixed income securities, and these are identical with the substitution of, well, notice PV of C sub 0. So there's the present value of the coupon. What did we have just slides ago? PV of D sub 0. So we're just substituting coupons in for dividends, and we can work through just a quick example here. let's see, time until the next coupon payment. That's probably important. 160 days. So the coupon payment, we get that 4% from the rate. Cut that in half, right? Times par value of 100. So $2 for the next coupon payment. Take the present value, so you get the 193. So notice we're taking the 110, which is the spot price, minus the 193. So what did we do earlier? We had the stock price minus the present value of the dividends. Now we have bond price minus the present value of the coupon. And then we need to compound that out, right? We're going to compound it out, 1.08, risk-free rate of 8, and then we adjust it to the remaining time on the contract. So we get the 112.72. So there's our kind of our new forward price. What was that? 112.72. So look at the bottom. What are we doing here? So a lot of this is just repetitive information. So we're going to take the 127 value of the bond and minus the 198, and then minus the 112. So we do all that again, but in this case, we need to adjust it for differences in time. So go ahead and work through that math. That should be pretty straightforward. How about futures contracts on fixed income securities? Well, we're going to do this in a very similar manner. However, we need to make sure that we distinguish between the price with and without interest. So the quoted price is known as the clean price. The full price is known as the clean price plus the accrued interest. So we may have to decide if we're not given that accrued interest, we probably need to go ahead and compute it. And so look at the very bottom there. There's our accrued interest. I think we did that back in level 1. And then, of course, with futures contracts on fixed income securities, if you're the short position, you're going to base the value on which particular bond is out there. And this is particularly true for Treasury securities, because remember, there's a billion or a trillion Treasury securities out there. So all you have to do is deliver one. So you're going to pick the cheapest one out there to deliver. So we might need a conversion factor, and we might need to consider the cheapest to deliver the bond. Notice what we have in that orange bullet point. The short will deliver the bond that is the least expensive. And so there is a good old quoted futures price formula, which includes a measure of the accrued interest. Now, what we're going to do is we're going to mark to market these futures contracts, not after 2 months or 3 months, but typically we're going to do these every single day if these are traded on an exchange. But remember, some futures contracts out there don't necessarily have to be traded in an organized exchange. They can be traded, somewhere else. But most of the time, these exchanges require mark to market on a daily basis. All right, how about forward currency contracts? So we're going to do the exact same thing here. Here's a good example. Current spot rate of exchange between US dollar and the Rand, 0.6757, 4% in US, 6% in South Africa. What is that arbitrage-free forward exchange rate? Well, we're going to do the exact same thing that we've done before. So remember this in terms of pricing currencies. So notice that F sub T, all right? So there's domestic over forward. So in this case, let's put the US dollar in the numerator. That's the domestic. Let's put the Rand in the denominator, right? That's the foreign currency. So remember this. We're going to put the 1 plus whatever interest rate is in the numerator on the currency over there, right? US dollars. So that's 1.04. And then 1.06 goes in the denominator. And then somewhere up there we were told it was 90 days. So there's 90 divided by the 365. And we get that forward currency contract price of 0.067, and that's in terms of dollars. So that takes care of those LOSs for forwards and futures. Let's go ahead and move on to swaps. And this is my favorite part of this kind of a concept. So let's go ahead and take a look at a plain interest rate swap. This is as plain and vanilla as you could possibly get. So here's the example. Let's suppose that we are an issuing entity. Maybe we're a corporation, maybe we're a government. And what we do is we've issued a bond and we pay our bondholders a fixed rate. So notice that we're paying them a fixed coupon rate, and we're probably doing it every 6 months, right? And a fixed rate. So what kind of interest rate risk are we exposed to? And the answer is that, well, we're paying a fixed rate. Maybe that rate is 10%. What happens if current interest rates fall to 5 or 4 or 2 or 1 or even 0? What are we doing? We've locked into paying our bondholders a 10% interest rate. So we suffer. We suffer if interest rates fall. On the other hand, if interest rates skyrocket, if they go to 20% or 30%, we've locked into that fixed rate. So we're super happy. What did I say to you earlier? Sense of pride, a sense of regret. Now, what could we do? Here we are. We're this issuing company and this issuing organization, and we're paying a fixed rate. And we're super worried about interest rates falling and paying a too high of an interest rate to our bondholders. So what could we do? I mean, we could issue another bond when interest rates fall, but we'd have to pay transaction costs to an investment banker, and we'd probably face some liquidity issues, and our bondholders might be faced with capital gains or capital losses. And so this may or may not be a good answer to our solution. But of course, there are derivative markets out there that are going to help us solve the problem. So in order to hedge this interest rate risk, why don't we pick up the phone and let's call a swap dealer, and let's ask the swap dealer. Now remember, this swap dealer is just some huge financial institution, like Jim's financial institution. So let's pick up the phone and call Jim and say, hey, look, we're paying this fixed rate to our bondholders. Would you do us a favor? Would you pay us that fixed rate so that we can pay our bondholders? You essentially would be financing that. So those payments go from the swap dealer through us to our bondholders. And of course, the swap dealer is going to say yes, right? I mean, financial institutions, they don't ever turn clients away. They don't ever say, you know what, go down there. They'll probably help you better than we can. Of course, the financial institution is going to say, yes, of course, we'll help you. But what do we get out of it? And so we'll say, hey, well, we'll pay you a floating rate. The swap dealer says, now that's what I'm talking about. We're going to get something out of this arrangement. So this is a plain interest rate swap. And this is a hedge. So all we're doing as the issuing entity is we're just getting the swap dealer to make our payments for us. And then we're going to make the opposite payment to the swap dealer. And so notice what this has done. It has turned a fixed rate bond into a floating rate bond. So when do we benefit? We benefit when interest rates fall. When do we suffer? We suffer when interest rates rise. So we would never do this as the issuer if we were super worried that interest rates were going to rise. We would only do this hedge. We would only execute this hedge if we thought interest rates were going to fall. All right, so I want you to keep this in mind as we go through valuation and pricing. All right, so here's a summary of the beginning part of this reading. Two parties exchange cash flows over multiple periods, a give and take benefits, usually to manage risk. Let me go back here to this one. Notice that I was the issuer we were the issuer in in orange, but we could just be some regular old investor. We could be a wealthy investor. We don't have to. We don't have to have issued a bond or own a bond. There doesn't need to be any arrow going downwards or upwards below that that orange box. We could just be someone who wants to bet on future interest rates. This is what makes swap markets so cool. The initial net value should be equal to 0, right? As one side of the swap contract gains, the other side loses by the same amount. Once again, zero sum. So look at that orange teardrop point. So the interest rate swap allows parties to exchange their interest rate obligations fixed for a floating, and that's what we did right here. Yes, why are we doing this? And this might be an important part of the question stem. We're going to manage interest rate risk. Or, you know, in my especially in my graduate corporate finance class, I tell my students that, hey, look, we're going to do this so that, boy, what did we learn from Modigliani and Miller? Maximize shareholder wealth. How do we do that? We invest in projects that have lots and lots of cash flows. We borrow money from the cheapest people out there that are going to provide us with that capital. But here's the really cool thing. We can use swap contracts to lower the weighted average cost of capital. Whoa, that is super cool stuff. All right, so there's a floating leg and a fixed leg. That is perfectly obvious from the boxes, the diagram that I gave you. And by the way, if you get to this question and you're not really super happy and super convinced that you know which way the arrows go, just draw this. Just go ahead and do this. And remember, you're going to ask the swap dealer to make the payments for you, whether they're fixed or floating. Swap dealer is your friend, but as your friend is going to require something on the other side. All right, so the question then becomes, just like with the FRA, how do we determine the fixed rate? And so this is going to be a similar, not identical calculation from before, but a similar calculation. And what I could do is I could say, hey, memorize that equation there in the middle, but I'm not going to tell you to memorize it. I'm going to go and show you an example, and then you're going to look back at that equation and say, oh yeah, that's what that means. All right, here we're given some LIBOR rates, 90, 180, 270, and 360. So once again, upward sloping yield curve. So what we need to do is we need to figure out what that swap rate is going to be, just like we had to compute that FRA rate a few moments ago. So let's go ahead and first calculate our present value factors. All right, so that's what the PV0T, that's what that means. So all we're going to do is take our yield curve, right? 19, 23, 26, and 3. We're going to put those numbers in the denominator, right? So our discount factor is going to be 1 over 1 plus. There's our yield curve. And then all we're going to do is make sure we adjust them by the time. So just to remind you, there's 90, 180, 270, 360. So there's our adjustment for time. And we get our discount factors that start at 99, they go down to 98, 98, and 97. Notice we have put in red the 1 year, 9707. Point of note, upward sloping yield curve, these numbers are going to be declining. So let's go ahead and figure out what that annual fixed rate swap is, but first let's do the quarterly swap rate. So all we're going to do is let's go back to that equation. There we go. 1 minus, so we're going to take 1 minus the biggest number. Well, how about if I say the smallest number? We're going to take 1 minus the longest term, which is going to be the smallest number, and then we're just going to add all of those discount factors. So notice what we do. We're going to take 1 minus, some big number. So that's going to be really small, like 2 or 3%. And then we're going to add all of those 99s and 98s and 97s. So that rate, that quarterly swap rate, it's kind of like an average, and then we need to compound it out 4 times, right? So you get 2.96. So let me just go back here real quick. So the 2.96, that fixed swap rate is going to be close to the 360-day LIBOR rate. Close. What do we get? Whoops, I'm going the wrong way. We got 2.96. A couple of notes there. Yeah, very close. We knew that. Use this tip to check whether your resulting swap rate on the exam. So that makes perfect sense, yeah. And then look at the last diamond point. The swap rate should lie within the spot range as it is seen. It's kind of, it's kind of like an average. I mean, it's not an average, of course, but it's kind of like an average. Can I call it a weighted average? All right, so now here comes the cool part. Let's go ahead and value an interest rate swap over time. And what are we going to do? We're going to do the exact same thing that we've done from the very beginning of this slide deck. We're just going to take the difference between two numbers, right? And look at the equation in there. We've got Fs sub 0 minus Fs sub t, right? So we're just going to figure out what that fixed swap rate used to be, right? And what the current fixed swap rate is. All right, so boy, I wish there was a shortcut. There is no shortcut. And so what we need to do is we need to recompute all of those things over time. So here's our example. Let's see, 500,000, 5-year, receive, that's important now, receive the fixed LIBOR. In fact, you know what I would do? I would take my pencil, and when you read the question stem and it says, you know, receive fixed or receive float, just circle it and just keep that in the front of your brain. What are we saying here? Reset annually 1 year ago. Suppose the fixed rate on the swap contract 1 year ago was 1.5. So we figured it out to be 1.5% a year ago. Here is the new discount factors based on the new LIBOR. So we didn't have to calculate those. In this question stem, we're given those discount factors. So we can easily get our new rate of 1.17. So what are we going to do? Here, skip down to the very bottom. Look at the V right there. So there's the 500,000. That was the notional, right? Yep. So 500,000 notional. And we're going to subtract the original 1.5, right? Minus our new 1.117. And then we're going to multiply that by the sum of all of those denominators. And we get 73.89. And so what do we know? We know that the receive floating party is going to lose. So that's just put a minus sign in front of that. Minus 73.89. Currency swaps. Well, we're going to do the same thing. However, we need to make sure that we have our numerating currency and our denominating currency in the same numerators and denominators. And that's really the only way that it's the most likely way that you'll miss this example. Now, with a currency swap, you have to have two yield curves. So here we have Euro yield curves, that's upward sloping, right? And then we have US yield curves, that's upward sloping. So what we need to do is we need to figure out what those annual fixed swap rates for both the Euro and the US dollar are. So we have to do the same thing over and over again. So I'm going to go ahead and just assume that you can compute that 2358 down at the bottom. Go ahead and pause if you feel like you need to and get out your calculator to confirm the annual rate for the euro on that slide and then the annual rate for the US dollar on this slide. That's probably good practice. Don't take our word for it. Just go ahead and get out your calculator and do it yourself. And then we can go ahead and figure out what the notional amounts and what that value is at some time in the future. And so that's what we do here on this slide. There's the 2.406 euros and the $0.265 million. Yeah, let's go ahead and value those. So notice we have a whole bunch of stuff here in the bottom. 1 year currency swap, annualized fixed rates, notional amounts are 500 and 200,000. So after a month, the British pound changes to 0.6. We have some extra information there, and we go ahead and calculate it for you. And so let's go ahead and figure out the value of the swap is closest to. And notice what we've done for you. We've put the reds, so the reds highlight to each other. So there's a 38,349 and then 39,145. So you can see where they relate to. Those are the sums, right? And then the greens are the days to maturity. And so you take the 186 minus the 288 and you get about $100,000 loss. Let's move on to the final LOS, describe equity swaps. And equity swaps are really, really cool instruments because what they allow you to do is exactly what we've done so far in this slide deck. Equity swaps allow one to swap a fixed for a floating return. But equity swaps also allow you to swap a floating for a floating return. For example, you could swap the return on the NASDAQ index for the swap for the return on the S&P 500 index. And what that floating for floating does is that it offers the opportunity that you lose on both legs of the payment, or you could win on both legs of the payment. The good news for you candidates is that as I looked through the reading and the examples, there were no floating for floating examples. They were all that first teardrop point, fixed for floating, which is to receive or pay an equity return. And so let me give you a little bit of background here. Think about it this way. What can you do with your capital? You can buy a share of stock or you can buy a bond. Well, when you're swapping in the derivative market, it's like you're taking the long position in one and the short position in the other. So when we're doing an equity swap, we're essentially swapping equity returns for fixed bond returns. Now look at that fixed swap rate there at the bottom. Man, oh man, we've seen that a bunch of times so far. So that's going to be no different in the equity swap. The value of an equity swap is going to be super similar to what we've done, but what we're going to do is really just take a look at the difference between the returns on a bond, that's what that FBC0 is, and the returns on a share of stock, that's what the ST minus 1 times NA. NA is the equity position in the underlying asset. And then we're going to subtract the present value of the difference between the par value of the bond and the investment in the equity. But let me give you a good heads up here. What the Institute does in its example in the reading is it has a sentence that reads something like, assume par value and the equity positions are identical. So that minus thing goes away. So it's going to be -0 in our example and in the example in the reading. And I'm guessing in probably all of the other examples. So really, this is a simple equation. We're just taking the difference between return on debt, return on equity. Let me show you what I mean by an example. Equity swap has an annual swap rate of 4%. All right, so we've already done, where am I here? We've already done that formula. All right. Notional of 2 million, index trading at 2,000. After 30 days, the index increases by 10% right up to 2,200. Here are the LIBOR rates after 30 days. So notice we have an upward sloping yield curve. So the value of the equity swap to the fixed rate payer, all right, so that's important. The fixed rate payer after the index goes up by 10% is closest to, well, we need to recompute that whole thing again. So let's go ahead and do the discount factors. Once again, feel free to pause the recording so you can compute those again. So you get the 99, 98, 96, 94. Those should be okay. Then let's go ahead and figure out what the value of the fixed rate bond is. So look, this is super simple. It doesn't look simple there, but this is all we're doing. We're taking 2% divided by 4. So there's the coupon rate chopped into quarterly payments. And we're going to just sum those discount factors. So we're taking the present value of the first coupon payment, discounting it at the 99, taking the present value of the second coupon payment, discounting it at 98, right? Then 96, then 94. And then we have to add the par value, right? 1 times that last one out there. So there's the price of a fixed rate bond, right? Par value is $1. So you get 98, 98,801. The value of the index, well, there we knew it went up 10%, so there's the 1.1. And so to get the value to the fixed rate pair, all we're going to do is take the 1.1 minus the 98. Don't forget to multiply it by that 2 million notional, and there you go. You get 223,980. And I think that takes us through our learning outcomes. So clearly this one is one that's a challenge for all candidates. However, it shouldn't be one that candidates say, oh, I'm going to go ahead and not worry about this reading. I promise you, you can do this. And so notice, describe. So I feel like I've done an okay job, maybe a good job, maybe a pretty good job of describing the big picture of how these things work, what these forward commitments look like. What are we trying to do? What are we trying to accomplish? And then the complexification issue then is to go ahead and calculate. Let's go ahead and figure out their price. Maybe it's a fixed price, right? Like we just did with the FRAs and the swaps. And then go ahead and calculate their value over time. And I think my original example was probably super helpful, the 110 over the 105 minus 1. So good luck on this one. I promise you, you can get these questions correct.